The 60% tax trap, a warning for company directors. If your income falls between £100,000 and £125,140, you could be walking into part of the UK tax system that many people don't see coming. It's often described as a stealth tax, an effective 60% tax rate, and it catches out high-earning company directors every single year. Today, I'm going to show you how the maths work and the areas directors typically review before the 5th of April to understand their position, without getting into personal advice. This is guidance. I'm Stephen Pitcher, Senior Partner with St James's Place, and for nearly 42 years I've been advising business owners and company directors how to maximise their retirement planning. First, the rules. In the UK, you're entitled to a personal allowance, currently £12,570, which is the amount you can earn before paying income tax. But here's the key point many people miss. Once your adjusted net income goes above £100,000, that personal allowance starts to reduce. For every £2 you earn over £100,000, you lose £1 of your personal allowance. By the time your income reaches £125,140, that allowance disappears completely. And this is where the so-called 60% tax trap starts to make sense. Let's look at just £100 of income in this range. Well, firstly, you pay 40% higher rate income tax. That's £40 gone. But because earning that £100 also reduces your personal allowance, £50 of income that used to be tax-free is now taxed as well. At 40%, that's another £20. £40 plus 20 equals £60. So, you keep 40, HMR effectively keeps 60. That's why this band is so often described as an effective 60% marginal tax rate, even though it doesn't appear as a single line on a tax return. This is something that often affects company directors more than people realise. That's because director income isn't usually just a single salary. It can include salary, dividends, bonuses, benefits. In a good year, it's very easy to drift over £100,000 without noticing, and only discover it later when the tax position becomes clear. Often the issue isn't earning more, it's how income is structured and understood. So what do directors typically review when they become aware of this? Well, I can't give personal advice here, but there are 3 areas that people commonly review at a high level before the tax year ends. Firstly, there's adjusted net income. Understanding exactly what counts towards the £100,000 threshold. Secondly, there's pension contributions. Pension contributions are often reviewed at a high level as they can affect adjusted net income and how allowances apply. And then thirdly, there's the household allowances, making sure allowances across a household aren't being unintentionally wasted. This isn't about rushing decisions, it's about understanding the rules early enough to have informed conversations. The 60% tax trap isn't a loophole, it's simply how the system works. But you don't have to walk into it without understanding what's happening. Over the coming weeks, I'll be breaking down other areas the directors often review at tax year end, including carry forward pension allowances, which are particularly relevant for high earners. And if that's useful, subscribe to the channel so you don't miss those updates. Proper planning starts with understanding, not panic. I'll see you in the next video.